Cleveland.
Hello, everyone. My name is John Cleveland. I'm with the Kansas City Federal Executive Board, and we are so excited that you're able to join us today for our monthly lunch and learn. We're going to be talking about the federal employee retirement system, along with some follow-up on the 7 common mistakes in planning your financial future. A little bit of a follow-on from last month. We will be recording this session, so just in case you need to drop off or some of your friends want this information, we will make it available afterwards. A quick note, if you would like to ask a question, please post it in the chat window. That will allow us to track and follow it. So again, thank you so much for joining us. And with that, Michelle, if you'd like to introduce our guest speakers.
Absolutely. I am pleased to announce that we have Matt Anderson and Becky Alves joining us again from our December's meeting with regards to the 7 mistakes to avoid in your financial goals. Matt Anderson is located here in the Kansas City, I'd almost say Kansas City field office, but the Kansas City area, which he
We appear to have lost Elaine, or I'm sorry, we've lost Michelle briefly. So Matt Anderson and Becky Alves are joining us from First Command, and we'd like to go ahead and just turn it over to them because they have a lot of amazing information to share with us this morning or afternoon, depending on where you're joining us from.
Okay, John. Well, thank you for the kind introduction. Just a little bit background in terms of Becky and I both work for First Command. Becky is in our home office and is a true expert in terms of understanding the federal employee benefits and does a lot of work making sure that she educates our advisor force around the country and frankly around the world to make sure that we can properly advise and give the best fiduciary advice to our clients. So me, as Michelle started to say, I'm located here in the Kansas City area. We've got an office in Leavenworth, and then we've got an office in Leawood, Kansas as well. But we're very happy to have this opportunity. And so, as Michelle said, this is the kickoff. So I hope everybody kind of had a nice holiday and you're starting to get back into the swing of things. I know that first week back, if you've taken vacation, you're digging through emails and whatnot. What we wanted to do today was do a recap of Becky's presentation on December 7th. So the December Lunch and Learn was in fact about the 7 common mistakes to avoid in pursuing your financial goals. So I'm going to share my screen here. And Becky, can you just confirm that everybody can see that?
Yes, we sure can.
Awesome. So here are the 7 mistakes that Becky went over. And the intent here is really just to provide the key takeaways from each of these 7 mistakes. And, if you have a specific question, we took a lot of questions and answers in December. We've got a few that we've got to clean up that I'll do after giving this recap. But if you've got others, as Michelle started to say, please just put that in Q&A. Our intent here is really just to educate. And so if it's a very detailed question, that's probably better to take that question offline. Everybody's situation is a little bit differently. But without further ado, here are the first of 7 mistakes is assuming that your financial future is set because you've got some tremendous federal benefits, which I'll cover later on in today's presentation. So the key takeaways from this mistake are, if in fact you think that because you are a federal employee and you've got these incredible benefits, that often leads to complacency. it often puts the focus on retirement only. And the other key takeaway of this is that federal benefits are individual pieces that fit into a much larger personal financial picture. The second mistake is not knowing how much you need for retirement. And so the key takeaways on this were, as we've all experienced, as we were growing up, people died sooner than they are now. And so life expectancies are increasing. People are being more active in their retirement, and the combination of those two may make a need for more income for a longer period of time. The third mistake is failing to take advantage of the thrift savings plan. You're going to have a great presentation next month. That's the topic for February's Lunch and Learn. But what Becky covered last time was the first takeaway is understanding the matching formula. We want you to get as much free money as possible from the federal government. And so if you contribute individually 5%, that you get a 1% automatic contribution, and then there's an agency match of 4%. We covered the concepts of Roth versus traditional, and we also talked about IRS contribution limits tied to that 401k-like program. The fourth topic is not having an insurance strategy. And the biggest takeaway here was that with FEB, which is a topic that will be covered later in 2023 as a lunch and learn topic, is that people often assume FEB is going to offer the exact amount of coverage that is right for their specific situation. And so what Becky's point was, is you really ought to take the time to calculate the specific need for your survivors and your specific situation. The fifth mistake was failing to plan for goals other than retirement. While retirement probably ought to be the most important, the highest priority goal, there are a lot of other goals that you probably have in life. And if you haven't established other goals, then that ultimately is going to eat into your retirement savings. So several of those goals were a home purchase, college education for your children, a child's wedding, vacations. Some people may choose to leave federal employment and start their own business, or in many cases, we know that emergencies crop up, and if they haven't set aside money to deal with that, then their only option is to pull that from their retirement investments. The sixth mistake is underestimating your spouse's or other survivors' income needs. We're going to touch on that today in terms of discussing the survivor benefits that are available with the FERS program. And then the last of the 7 mistakes, we're worrying about things that you can't control. So there are 3 variables that are associated with investments. Those variables are time, when do you start investing and how frequently are you doing that? The input, how much are you contributing to your financial plan? And then lastly, the rate of return. Well, you can guess by the first 2 that the time and the input, you can control that. But the third is the rate of return. The market, as you all know, you see it every night on the news, it's been very volatile. And in fact, the market's been down this last year. It's on its way back, but simply you can't control that. So if you will focus on controlling the first 2, we've shown that has a larger propensity of attaining your financial goals than the actual rate of return. So with that, that is the recap from Becky's presentation. What we we ran out of time because there were so many great questions that we weren't able to fully field all of the questions from last time. So what we wanted to do was finish answering those great questions. And then at that point, we'll move on to discussing the FERS situation. So the first was, what are the risks to a hands-off approach with respect to the thrift savings program? Well, in large part, the risks are that you aren't monitoring your investment. It's kind of on cruise control. So specifically, if you're in the wrong fund, you might not be making the return that you could be making to the point of the rate of return that we just talked about. So we do offer a complimentary analysis and recommendations that are based on an individual's goals and their specific risk tolerance. I would recommend that you meet with a financial advisor, whoever that is, to provide that assistance. However, as a federal employee, and if you truly want that hands-off approach, then what you would want to do is look at the correct life cycle fund that is based off of your final retirement age. So an example of this might be, if I'm 35 years old, and you can see by my hair color that I'm not, but if you're 35 years old and you intend to retire at age 67, then you would pick the L2050 or L2055 fund, which is a target date fund that with the life cycle or any target date fund, it starts aggressive and then becomes more conservative the closer you get to approaching that retirement age of 67 in this case. The next question we had is, what is the difference between FEGLI, term, and whole life? Again, FEGLI, you're going to have a whole hour session sometime later this year. So I won't take a lot of time today to describe that, but I think everybody is fairly familiar with FEGLI. It is a group term life insurance that's offered by your employer, the federal government. And with any employer life insurance, it covers, it provides a death benefit while you are employed with that employer. In most cases, once you leave that employer or you leave service with the federal government, you lose that coverage. FEGLI actually has a couple different options. Again, that will be covered later on this year. So in terms of how that best ties into your overall financial plan, any financial advisor should be available to help you work through that. And then Becky also took some time with us in December to show us where you can find the FEGLI specifics on opm.gov. And I too will show some of the benefits that I'll talk about at the tail end of my presentation this afternoon on where you can find that. A term policy is similar to FEGLI. The difference is those term policy, rather than being offered by an employer, is on an individual basis. And it's a life insurance policy that covers the insured person for a specific period of time. Usually that's anywhere from 5 to 30 years. At the end of that time, the coverage ends. So if I died after that term had expired, then I would not have any coverage at all. There would be no death benefit paid to my designated beneficiaries. However, if I got to the end of that time frame, 30 years, 10 years, I could choose to renew that term policy. However, that's going to be more likely at a much higher rate than that initial term policy. And then there's this thing called cash value that's associated with a permanent policy that's not available in term. And I'll explain that here when I talk about whole life. So whole life is one of 3 types of permanent insurance. With permanent insurance, as long as you pay the premiums, the death benefit's going to be guaranteed for the insured's lifetime, thus the term whole life. The other 2 types of permanent insurance are indexed universal life and variable universal life, and there's others, but those are the three primary ones. With all three types of these insurance, the death benefit is in fact guaranteed. And in most cases, that premium is guaranteed to never increase. Permanent policies do build cash value, which allows some options later on in the life of that policy. The owner or the insured could cancel or surrender that policy and get back some or all of the premium that has been paid in. Another option is that they could stop making that premium payment, and instead of getting a $100,000 death benefit, take a lesser amount of death benefit. Whatever that death benefit is. I used 100,000, it might be 500,000. And so that's called a reduced paid up option. And then the last is that you do have an ability to take a loan from that policy with the intent of either repaying it and restoring the original death benefit, or just keeping that loan and not repaying that loan. There are some tax advantages with whole life or permanent insurance. Again, that's a discussion that should be held on a case-by-case basis. The next question we had was, what are the actions to take to lessen the impact of inflation on investments and preparing for retirement? Well, investments are a long-term tool to make a higher return than inflation. However, as we've seen this last year, there is a risk that that investment might lose some money in the short term. So when an investor is young, they have a long time to invest. And over time, by remaining in the investment, that will most likely outpace inflation. However, an investor should ensure that their investments are diversified and that they have holdings in the different asset classes, such as stocks or equities, bonds or fixed incomes, or cash and government securities. As the investor gets closer to their actual retirement age, not retiring from federal employee work, but when they actually plan to stop working altogether, then they ought to look at becoming a little more conservative. Again, that's kind of how that target date fund or the L fund series that I talked about with the TSP is working or is conceptualized. So even in retirement, depending on how long the retirement funds need to last, there's still a need to stay ahead of inflation. Again, this year is a great example of that. So there are an assortment of investments and other products that are available to ensure that that investor can retire and then ensure that they have enough funds for their retirement until they pass. Again, this is where there's great value in working with a financial advisor. Our last question had to deal with long-term care. We talked a little bit about that in the 7 mistakes, but I'm going to paraphrase the question, and it goes like this. There was an understanding or a misperception really of, in order to get long-term care, that this individual had heard of people having to transfer ownership of their home and their property. Well, that could be the case if you didn't have any other alternatives. And in that case, what was described there is that you're really referring to trying to become eligible for Medicaid. And in order to get that benefit from the government for everybody in the United States, you really have to go down to poverty levels. And so specifically for long-term care, which we'll address briefly in today's presentation, what we'd rather do is, like life insurance, there's long-term care insurance that you can pay a premium on that will transfer the risks of the high cost of that care, whether that's home health care or all the way into a skilled nursing facility. Those costs are fairly expensive. And so by having long-term care insurance that can be in place to help protect the wealth that you've worked so hard to accumulate over the entire time that you've been a worker in the United States. Specific to the federal government, there's a federal long-term care insurance program. Again, I'm going to address that in my next part of the presentation. So I think that closes us out for the December 7th presentation. And now I'd like to take a second, switch my screen, and let's focus on the federal employee retirement system. Becky, while I'm doing that, if there's anything else that you'd like to fill in, feel free to do so.
Sure. So I would just again echo the sentiments that Matt spoke to in the beginning, that happy to be here, happy to be with you guys, educating you a little bit on some of your benefits through the federal government. That's key, right? So I hope today that you get one nugget, whether it was in the wrap up and the review from the 7 common mistakes that we can often make, or if it's in maybe some of the little nuggets we found in the responses from the leftover Q&A from last time. In the next 40 minutes or so, Matt's going to be sharing some incredible information about our FERS annuities and how those are calculated. And in addition to that, what does the healthcare plan look like for our federal employees? And what does the dental and vision plan look like? And while at this very moment, the long-term care through federal government is on hold or on pause, we're going to talk a little bit about what that looks like when it's not on pause, because they only do that every several years, like every 6, 8, 10 years, right? Whenever that comes up for renewal. So we'll dig into that a little bit later. And then I've got some tools, some websites that I'm going to pop in the chat at the end of our discussion. So if you wanted to grab those at the end, and those will take you direct links into the OPM website on a lot of different things. The FEGLI calculator that I displayed last time, along with the rate chart, the health benefits page, the dental and vision plan page, and as well as a FEHB comparison tool page. So I'll pop those in the chat at the very end, and I'm going to go ahead and pause and let Matt take it from here.
Okay, thank you, Becky. So today we just we're here to educate at a high level about investing, pension, and then the insurance benefits that are available to federal civilian employees. So without further ado, I'm just gonna dive right in. So I know these are some disclaimers. Being in the federal government, you guys are all familiar with government regulations. We too, from financial service industries, have to meet compliant piece. So thanks for letting me show this. But I really want to highlight, we are here to educate you all that are participating, and if what we've provided is valuable. John mentioned up front that this is being recorded. Please, let's make our colleagues as informed as you are today. So there are 6 major employee benefits that you can receive as a federal employee. I've grayed out the TSP and FEGLI because we said that TSP will be covered next month and FEGLI is coming up sometime in calendar year 2023. So we'll focus on the FERS annuity, the federal employee health benefit. We'll provide a quick update on the federal long-term care insurance program, and then conclude with survivor benefits. So the FERS retirement plan really is providing retirement benefits from 3 different sources. And I'd like to just kind of make some distinctions here in terms of where those start with. So FERS was actually created when Congress decided to expand the Social Security benefits to the federal employees. And then consequently, the FERS basic benefit plan requires smaller contributions and pays less retirement income, allowing for the fact that many employees may not retire from the federal government. And in order to qualify, FERS employees must have 5 years of creditable service. So there are 3 different categories within the basic plan. FERS employees who were hired before January 1st of 2013 contribute 0.8% of their pay to the basic benefit plan. FERS participants hired after January 1st of 2013 are referred to as revised annuity employees, and they contribute 3.1% of their pay every month or every paycheck. And then those hired after January 1 of 2014 are referred to as further revised annuity employees, and they contribute 4.4%. And that last change was made in the federal budget established in 2014. There are special rules that apply to air traffic controllers, law enforcement officers, and firefighters. Let's talk about the eligibility real quick. Voluntarily, or what's more commonly referred to as standard retirement, is available with the full retirement annuity benefits once an employee meets one of the following criteria. They either attain the minimum retirement age and 30 years of creditable service, or once they reach age 60 and they have 20 years of creditable service, or if they start late as a federal employee and they've worked for at least 5 years of creditable service and have attained the age of 62. And lastly is once they've achieved that minimum retirement age and 10 years of credible service, and then that's reduced by 5% a year for each year under age of 62. Very quickly, I know you all know how to read your LES, but I thought I would share just a couple of things for those that might be new, or you just want to pull out your most recent LES when you get home tonight and just kind of see how these might impact you. So in terms of your pay and pay grade, obviously, there we go. Your pay and your pay grade are going to be important. This is your service computation date, where you can find that located here. Here's your basic pay, your locality adjustment, and then your overall pay. And that is what's going to be important in terms of where you can go find the raw data as we look to compute how much you might be getting from your retirement annuity. So I don't know if anybody's a veteran. I am, so that hits near and dear to my heart, but I do know that there are a number of federal agency employees that leave their service with Department of Defense and then continue their service to our nation as a federal agency employee. And so just for those that are on the call today, remember that your honorable active duty military service is generally creditable for federal civilian retirement purposes. The time that you spend in the military is only creditable for your civilian service if you make a deposit for that service. This is commonly called a buyback. So during that time that you were in the military, you were not contributing to the CSRS or FERS retirement fund. So that makes sense that you did not get credit for that time until you make that deposit. So although it might seem expensive at first, you should seriously consider the impact that buying back that time will have on when you can, in fact, become eligible to retire and in calculating your overall annuity. And the deposit election information and the forms are available on the OPM website, opm.gov. So let's look at an example of how to compute your retirement annuity. In this example, our FERS employee is going to be 62 years old, and they will have worked for their agency for 25 years. And his annual retirement annuity is going to be determined by several variables. The first is calculating the average amount of the 3 highest years of pay. And in this case, that high 3 average is going to be $41,833. So the amount of I'm just going to build this out. So the amount of the retirement annuity is going to depend on the employee's age. We said 62. The length of service, 25 years. And the high 3 average pay, which we said was $41,833. So when you look at why 62 matters, is that creates a variable of if you are 62 or older, you get a 1.1% multiplier. If you are age 62, if you're under the age of 62, or you are 62 but have less than 10 years of service, then that multiplier is just 1%. And so when you multiply the high average 3 times the length of your service times your age multiplier, in this case, you would receive $11,504 on an annual basis. The other thing that I'd like to note is that the retirement annuity, should you elect the survivor benefit, that survivor benefit, the cost of that would be deducted from this annual annuity. Told you I'd show you an LES of some of these other factors. Oops. So in terms of the other benefits, the 6 benefits that we've talked about, we've got the FEGLI. Where you find the FEGLI is right here. We've got the TSP contribution, which is here. We've got the FERS, the federal employee health benefit, and then in this case, there's dental. There might be vision. I also want to highlight that one of the great benefits of being a federal agency employee is that these are your contributions, but when you look down below at towards the bottom of your leave and earnings statement, that the federal government is making a contribution on your part as well. And so they will pay part of your FEGLI premium. They are paying a part of your FERS. And as we talked about in the 7 mistakes, here's the matching piece from your agency. Here is the basic piece. And then lastly, they're also contributing to the federal employee health benefit if you're taking part in that benefit. So the federal employee health benefits program it's not compulsory. And so therefore employees, you have the right to decline to participate if that's your choice. Generally, all federal and postal employees and retirees, as well as many temporary and special category workers, are entitled to participate in the federal employee health benefits program. There are different options of enrollment. You can enroll to cover you yourself, the employee only. You can enroll in the Self Plus One program, or you can enroll in the Self and Family. If that family includes both the spouse and the children, and you are not, the spouse and the children are automatically covered, even if you don't list them when you're signing up for this benefit. To clarify, children, just like many of other benefits, once your child reaches the age of 26, they're no longer able to participate in this program unless they're incapable of supporting themselves due to a disability that began before they turned the age of 26. The great news on this program is that enrollment is available within 60 days of your appointment as a federal employee at any open enrollment period, which typically runs from the first Monday of the second full week in November through Monday of the second full week in December. The last piece from a tax perspective is these premiums are paid with pre-tax dollars, and typically they change every year based off of the contract negotiations with the individual carriers. And the government, as I just showed you on the LES, shares a part of the cost of paying that premium with the employee. Tied to the federal employee health benefits is a program called FEB. So within FEB, there are dental insurance plans and there are vision insurance plans that operate completely independent of one another. So therefore, as an eligible employee, as well as the retirees that are actually taking their FERS annuity, they can enroll for dental insurance only, vision insurance only, both or neither. And if you're enrolled in both, you may choose different enrollment types to cover your different family members in each one of those. So in this case, there is no cost sharing by the government. You, the employee, pay the entire premium. From a good standpoint, in many cases, insurance companies put some conditions in place that would allow people not to participate with this program. None of those pre-existing limitations are in place. And finally, there are a number of carriers for both vision and dental. There are 5 vision carriers and 13 dental carriers. Again, opm.gov and the website that I will show you later on will provide you all those different options. But you've got a really great choice to pick what will be the best fit for each of you and your situations. So we talked about the federal long-term care insurance program. This program had been offered by John Hancock. It's a great program that right now is currently suspended. And so that would be the takeaway today for you. If you were looking to get into the federal long-term care insurance program, it is currently suspended. It was suspended on December 19th of 2022, and it potentially will remain suspended for 24 months or until OPM issues a subsequent notice that ends that suspension earlier. So what does that mean to you? One, if you were enrolled in the federal long-term care insurance program, you still are covered. So that's the good news. The bad news is if you were wanting to look at this program this year, that currently is not available to you until this suspension is lifted. The last of the 6 major benefits is survivor benefits, and there are 3 types of those survivor benefits. we've got the spouse, former spouse, and insurable interest. And I'll do a deep dive on each of these categories. Oops. So this pre-retirement survivor benefits exist for somebody that dies while they're currently serving as a federal agency employee. And there's actually two categories where this benefit could potentially be in place for you and your family. So the first exists from 18 months to 10 years of service. And if that were the case, you would see a lump sum benefit of $40,000 or $40,300 provided to your family, plus an additional lump sum of the higher of 50% of your employee annual basic pay at the time of death, or 50% of the employee's high three average. Then they are also going to pay for your Social Security benefits, any TSP benefits that you have, and then child survivor benefits if you have any eligible children. If you've served longer than 10 years, then this becomes the formula for how your surviving spouse would see that amount of money. So the earned annuity is computed in roughly the same manner as the retired employee, but there is no reduction of age. So in this case, we talked about the high three salary being $60,000. In this case, they died while serving in a federal agency, but they'd been there for 20 years. And because they are less than age 60, they get that 1% multiplier. And so if they had lived, their annual benefit would be $12,000. However, they didn't complete their service, and so you get paid 50% of that benefit. So in this case, your surviving spouse would see $6,000 annually as a survivor annuity. Moving on to the children. If there is a surviving spouse in the situation, then the survivor benefit is paid not up to $900 per month per child, and you're capped at up to 3 children. So the total maximum benefit paid per month would be $2,700. If, for example, maybe you and the spouse die in a car accident, and therefore there is no surviving spouse, but there are children, then that survivor benefit per child increases to $1,080 per month per child, with a maximum total benefit of $3,240 per month. Assuming that most people are going to live all the way through seeing retirement from their federal agency, this is probably the more common benefit that you're interested in learning about, and that is the surviving spouse of somebody that is in fact retired and using the FERS annuity system. Like we talked about, they get to keep 50% of the retiree's full annuity. The other thing that's important to note here is that in order to keep those federal employee health benefits, you do have to elect to participate with the minimum survivor benefit program for the spouse. So in terms of a recap, there are 6 major parts to a federal employee retirement system. We've covered a lot of that information today. We really just kind of hit the high points of each of these benefits in a brief overview. Again, please feel free to contact a financial advisor or talk to a supervisor or your colleagues if you want to learn more about each of these. I am going to switch my screen to be able to show you the OPM Gov site that I told you I wanted to discuss.
So Matt, we did have a question from the audience. Nothing really that you covered or didn't cover. Just curious if there's a cutoff date for buying back service with AmeriCorp. So big picture is depends on when you were in service and what rules you fell under, if you were a CSRS or FERS. But here's what you want to do. You want to go to OPM. You want to ask them specifically, how much time do I have that I could buy back? And what is that going to cost me? Once you have that information then can be analyzed in the larger picture of a financial plan and determine, is that a good money choice? Is that a good use of money buying back? Because depending on how long it's been, you're going to have to buy back the time plus interest. And that's going to cost you a premium. So depending on how much it's going to cost you to buy back however much time, then you can analyze, is it worth it or not? But that needs to be considered in the larger picture of your holistic financial plan. Great question, though.
Thank you, Becky. So, Becky, can you confirm that you're looking at the opm.gov healthcare and insurance?
I can see it.
Awesome.
You might want to, if you can, shift and plus just to enlarge it for some folks. Perfect. Good.
There we go. So here is, I think you probably all know how to get to OPM, and Google is always your best friend, but specifically I wanted to take you to the healthcare and insurance piece as a follow-up to some of the benefits that we talked about. And so here's the healthcare. There's a great comparison tool for the health benefits in terms of the dental and vision. Here is, we can drop into that. That'll take you into a very comprehensive fact sheet of the dental and vision program. Go back. With life insurance, again, FEGLI, you're going to get that. The long-term care found here. Becky mentioned she was going to talk about the FEGLI calculator. That's located here as well. So just a really great source of information. If you haven't watched, there's some really great YouTube videos that describe your benefits. So my hat's off. A lot of websites generally aren't this well structured, but OPM really has some great information. And again, you can find the website, this website located here, and I believe that that's been posted into the chat function. So with that, that's all I had to present formally. We've got about 12 minutes for question and answer. And Becky, we'll go from there.
Perfect. So Matt, while you're on this page, there are no other questions in the chat. Oh, I'm sorry, there is one. It seems like once you choose FEGLI plan, you are locked in absent a qualifying event. Open season isn't every year, may go many years. Many of us choose FEGLI based on when we started employment years ago, and life has changed since then. When can we expect the opportunity to change options? That's a great question. So generally, anytime one of those major life events happens, right? We get married, we get divorced, we have a child, maybe we're widowed. Anytime any of those events happen, you don't have to wait on an open season. There is a period and I can't put my fingers on it now, but we will follow up, where you've got maybe a 30-day window or a 60-day window that you need to contact OPM and let them know that you want to change those options. That's a really great question. And I know that they're going to be presenting the FEGLI at a future event later this summer, I believe. So I think you're going to get a lot more context and about all the rules. I did drop in the chat, the FEGLI calculator. And so I'll go in there and dig and see what those life events, or if you just changed your mind, when you can make those changes. We have another one here stating, Matt, that says, I turned 55 and my FEGLI life insurance premium doubled. And I was also wondering when I can reduce that. Yeah, so let's go on this page, Matt, while you're here. If you'll take us to the FEGLI calculator and see what happens to those tabled rates. In fact, I'm going to pull up the tabled rate. Yeah, so when you change that from an under 35 individual to a over 55, you're going to see how those start changing in the different brackets down here. Those indicate an increase. Yeah, just put like 100 grand in there.
Okay.
Just pick any salary. And this is just for the basic, but we should be able to see. Yeah, so go ahead and hit next. Yeah. Absolutely. So 16 cents per thousand, right? And so when do we want to make those changes to FEGLI? Great question. I'm going to put my finger on that answer specifically and get you guys an answer.
Okay, and one of the great things about FEGLI, again, you're going to have a whole deep dive, but one of the benefits that maybe some of you are unaware of is that as long as you are enrolled in FEGLI before you retire, you have the option of reducing some of that coverage. But as we showed on the LES, where the federal government is paying for some of that benefit, once you reach the age of 65, in some cases, you basically get that coverage for $0. The government is going to make that premium pay for you. And again, that's where meeting with somebody specific, working through how much does your family need, what's the best approach to protecting your family. Again, going to last month's presentation of a mistake of combining several, that's where working with somebody that's familiar with that can come up with the best coverage at the least amount of money from a premium standpoint to protect you and your family situation.
Thank you for that. So let me just kind of circle back on when you can make changes. If you are an active employee, active federal employee, you can reduce or cancel your FEGLI life insurance at any time without waiting for an open season. You just have to complete and submit a specific form. I put it in the chat. I think it's SF 2817. Submit that to your human resources office. And then you can sign up for only the coverage you want to retain. If you're already retired, though, there is no form you need to complete. You just need to, and I've dropped it in the chat, you just need to write a letter and submit that by snail mail to OPM in Pennsylvania and let them know what coverages you want to drop. Here's the caveat, though. If you're already retired, you cannot enroll, increase, or restore canceled coverage. So be very careful, especially if you're already retired there. And then just make sure that your beneficiary designations are up to date. Life changes every single day, every single year, and sometimes we forget to go back and change those beneficiary designations. Always make that a part of your annual updates that you are checking those beneficiary designations every single year.
That's a great point, Becky. Hey, John, do you know, did Michelle get tied back in to us, or was there like
Yes, Michelle has been able to rejoin us.
Okay, awesome. All right. Well, we've got about 6 minutes by my time. I don't know if there are any further questions. If there are, we'll take, one or two more questions. If not, then we can wrap up for today.
Right. Thank you so much, Matt. We do have a post session survey that I'm launching now. Just ask you to take a few seconds to go ahead and fill it out. That would be super appreciated. Otherwise, we will be making this available afterwards on the recording. So stay tuned for an email with that link.
Okay. I'll kind of close out on behalf of Becky and myself. We've truly are appreciative of the opportunity that we had in December and now today to try to educate the Kansas City federal agency employees about some of the financial aspects. Again, I'd encourage all of you to tune in next month, because the TSP is a huge part of your retirement piece and it all fits together, as well as FEB is a great life insurance program. There are a lot of nuances, as we touched on just a few minutes ago, about things that you need to make very deliberate decisions about prior to leaving employment with the federal agency before you retire, that not only impact whether you have that insurance or with the SBP, if you don't take that, making sure that you realize that then you might unintentionally cause a second order effect of not being eligible then to participate in some of those other benefits. So we appreciate the opportunity to be here. Should anybody have further questions, I think Michelle has my information, and I'm more than happy to meet with anybody on an individual basis. So with that, again, thanks so much. All the best in 2023. And Michelle, I'll turn it over to you.